Hello, everyone, and welcome back to Gold Off the Charts. In a financial market that's often a foggy maze of high-stakes games, we don't just watch the surface-level drama. We look for the real mechanics driving the moves. Our goal is to provide a bit of deep financial insight every day, helping you see further, trade more steadily, and stay profitable longer than the average investor on your journey to building wealth. I'm recording today's video with a level of seriousness I've rarely felt before. Why? Because we are witnessing history in the making, a superstorm that could completely flip the global financial script. If you were watching the charts yesterday, you were likely on the edge of your seat. We saw extreme panic ripple through global markets as the standoff between the US and Europe over Greenland reached a breaking point. This isn't just a simple move into safe assets anymore. It's an epic sell America trade. On Tuesday, global investors began dumping U.S. assets in a massive, coordinated sell-off. In response, the 10-year U.S. Treasury yield spiked to its highest level since last August, while the U.S. dollar took a massive hit, dropping off a literal cliff. Meanwhile, panicked capital rushed into the ultimate safe haven, gold. Spot gold ignored every level of resistance, smashing through the $4,800 mark to hit yet another record high. It jumped over $100 in a single day. Let that sink in for a moment. This tells us that the market's fear about the future has officially hit a boiling point. Silver also climbed, though it couldn't quite keep up with gold's pace. This confirms exactly what I warned you about in last Friday's video. The paths of gold and silver are splitting. Gold is accelerating as the undisputed safe haven king, while silver is starting to feel the weight of more volatility and pressure. If you've been a long-time follower of Gold Off the Charts, this shouldn't come as a surprise. Our channel's analysis is a continuous story, so if you're new here, I highly recommend watching last Friday's video. It'll give you a much clearer 3D view of the logic behind the current market chaos. Now, let's get back to today's big story. With gold making such a jaw-dropping move over the last 24 hours, everyone is asking, what happened? Why the sudden panic? And how much longer can this rally actually last? In today's deep dive, I'm going to break down the currency war happening behind the scenes, the capital battle between the US and Europe, and the massive gold buying spree by global central banks. First, we have to understand that this risk-off mood is different. The usual rules of global geopolitics have been tossed out the window. Three specific signals from yesterday all point to the fact that a financial war is picking up speed. We need to think about the worst-case scenario. The first sign of this brewing storm comes from a very familiar dealmaker, Donald Trump. His high-pressure tactics have effectively lit the fuse on this Sell America firestorm. You've likely seen the photo going viral on social media. This single image is more powerful than any official press release. Trump shared a photoshopped picture of himself landing on Greenland, planting an American flag. Standing behind him were Vice President Vance and Secretary of State Rubio, looking like they just discovered a new continent. A massive sign next to them reads, "Greenland will become a U.S. territory in 2026. If you thought this was just Trump being Trump, the next scene will make world leaders everywhere break out in a cold sweat. In another theater of this conflict, he even went so far as to include Canada and Venezuela in his territory map of the United States. Think about that for a second. This is practically unheard of in the history of modern diplomacy. When the president of a global superpower publicly shares images showing neighboring and sovereign nations as part of his own territory, it's not just a stunt, it's a blatant middle finger to international law. It completely ignores the sovereignty of allies and the entire global order established after World War II. It sends a chilling message. In Trump's world, there are no real allies, only interests. There are no borders, only America's backyard. This is a raw declaration of imperial power, and it has absolutely infuriated Europe. To the EU, Greenland is Danish territory and a vital part of Europe. If the US can just claim to buy or annex European land whenever it wants, what is the point of NATO? Can there be any trust left in the Western alliance? The EU didn't stay quiet this time. They fired back with a massive move. The European Parliament has frozen the ratification of the US-EU trade agreement. This is a heavy blow. It means the US and Europe, the closest partners since the 1940s, have officially hit a wall in trade and diplomacy. That rock-solid alliance, it's cracking, and it could fall apart at any moment. The markets reacted instantly and brutally. If capital hates one thing, it's uncertainty, and Trump's actions just created a massive amount of it. As a result, U.S. assets were dumped. All three major U.S. stock indexes dove nearly 3%. This wasn't just a healthy pullback, it was panic selling, with investors fleeing at any price. Even the Magnificent Seven tech giants, usually seen as safe bets, took a hit. Nvidia dropped over 4.3%, and Tesla fell more than 4%. Why? Because if a full-scale trade war breaks out, the overseas profits of these global tech giants will be the first to suffer. When political risk enters the room, even the AI hype starts to look fragile. The bond market was even bloodier. 10-year Treasury prices crashed to a 5-month low, pushing yields up to 4.3%. Meanwhile, the US dollar index saw its biggest one-day drop in over a month. The US market experienced a classic triple kill across stocks, bonds, and the currency. This chaos sent the VIX Fear Index screaming to its highest level since last November. Investors are voting with their feet, telling the world, in an America that ignores the rules, U.S. assets aren't safe anymore. Now, let's look at the second, deeper reason behind this massive sell-off. We are looking at a potentially devastating capital war between the U.S. and Europe. Remember, European nations hold roughly $10 trillion in U.S. bonds and stocks. While a lot of that is in private hands, a huge portion is managed by public sector funds. Historically, Europeans bought U.S. debt because it was the safest place to be. They bought it for liquidity and as a sign of ally solidarity. But now, the market is betting on something different. That these countries might start dumping their dollar assets to retaliate against Trump's new tariff threats. As Bloomberg strategists put it, the collapse of globalization is accelerating. This highlights the urgent need for nations to fund their own defense, energy, and social welfare. In an era where central banks won't cut rates, government bonds are no longer seen as a safe shelter from these geopolitical storms. That is a very heavy statement. It means U.S. Treasuries are losing their status as the anchor of global finance. If Europe really weaponizes its U.S. holdings, things will escalate fast. This would turn a trade war into a financial war that hits the heart of the capital markets. We're moving beyond simple tariffs toward a scenario that drains liquidity from the U.S. financial system and attacks the dominance of the dollar. Let me explain why this logic is so terrifying. If Europe sells U.S. bonds en masse, bond prices fall and yields spike. What happens when yields spike? It means it becomes much more expensive for the U.S. government to borrow money. The U.S. is already buried under $38 trillion in debt, and annual interest payments now cost more than the entire military budget. If borrowing costs go up further, the deficit will explode, potentially leading to a debt default. It's a death spiral. Sell-offs lead to higher yields, which ruins finances, drops credit ratings, and triggers more selling. Now, most U.S. assets in Europe are held by private funds that the government can't just order to sell, but capital follows profit and flees risk by instinct. Even without a government order, the money will move on its own. In fact, some of the most conservative players' pension funds are already making their move. We just saw a major canary in the coal mine moment. The Danish pension fund, Akademiker Pension, announced it is liquidating its U.S. bond holdings. Their chief investment officer, Anders Schelde, was blunt with the U.S. is essentially no longer a reliable credit entity. He added that the U.S. government's fiscal path simply isn't sustainable. Pay attention here. This isn't a risky hedge fund manager talking. This is a conservative institution managing $25 billion for teachers and academics. Their investment style is famously rock-solid and cautious. They think in terms of decades. Schelde revealed that while they only held about $100 million in treasuries by late 2025, a small drop in the bucket for the U.S. market, the signal it sends is massive. He said the only reason to hold U.S. debt was for risk management, but now they believe they can find better alternatives. He's telling the world, U.S. debt is no longer irreplaceable. As trust in the U.S. fades, more funds across Europe and Asia might follow suit. They'll ask, if the U.S. can sanction anyone at will, or if the president can just claim other countries' land, is my money really safe there? If even the safe pension funds are running for the exits, the rest won't be far behind. So, where does all that trillion-dollar capital go once it leaves U.S. debt? It needs an asset that is huge, secure, and doesn't depend on any single government's word. That's right, gold becomes the primary, if not the only target for that big money. This is the core reason why gold is hitting new highs even as the dollar tries to bounce back. Beyond the US-Europe chaos, let's look at the third factor driving gold's surge last night. This is the most direct spark: the massive wave of gold buying by global central banks. Last night's rally was fueled by news that one of the world's biggest buyers, the National Bank of Poland, approved a plan to buy another 150 tons of gold. You might think of Poland as a smaller player, but this move is massive and highly strategic. Poland's central bank governor wants to raise their gold ceiling from 550 tons to 700 tons. Based on today's prices, this batch of gold is worth nearly $23 billion. To put that in perspective, that's more than the entire gold reserves of countries like Brazil or Mexico. The Bank of Poland stated proudly that this will put them in the top 10 largest gold reserve holders in the world, and they aren't just talking, they're acting. In 2025 alone, Poland bought 100 tons, the largest purchase by any central bank reporting to the IMF that year. Currently, the Bank of Poland is authorized to put up to 30% of its reserves into gold. While the exact timing isn't set, their direction is crystal clear. Why the gold fever in Poland? It's deep geopolitical logic. Poland is on the front lines, bordering Ukraine and Belarus. They know better than anyone. When the drums of war beat and superpowers clash, gold is the only true protector of wealth. They know their history. During World War II, Poland had to ship its gold overseas to keep it from the Nazis. Now, they are hoarding it again to prepare for whatever worst-case scenario comes next. And Poland isn't alone. This constant buying by central banks has been the floor for gold's massive rally. In just 18 months, gold prices have doubled. This trend accelerated in 2022 after Russia's reserves were frozen. That event taught central banks a hard lesson. Dollars can be frozen, but physical gold cannot. I want to emphasize that for central banks, the biggest players in the game, the need for gold is strategic. It's a requirement, not a luxury. When you're hedging against a total system collapse, you don't care if gold is $4,000 or $5,000 an ounce. You just need to have it. In an extreme crisis, your dollars could be sanctioned or become worthless paper, but gold will always be hard money and the basis for new credit. We are entering a rare market phase where the more expensive it gets, the more people buy. It's a positive feedback loop that's very hard to break once it starts. Finally, we have to talk about one more factor pushing gold higher, something we've covered before, the Japanese yen. I know the yen story can feel repetitive, but the carry trade reversal is a black swan event that is getting dangerously close to reality. Rising yields in Japan are creating a huge concern. Japanese investors might dump their U.S. Treasuries and bring that money back home. This would drive U.S. bond yields even higher, making it even harder for the U.S. to fund its debt. We're seeing weak demand for Japan's 20-year bonds, which is making everyone nervous. Yields on 40-year Japanese bonds hit 4%, a record high since that product was even created. What does this tell us? For Japanese investors, the math of holding U.S. bonds no longer works after you pay to hedge the currency risk. It's just not attractive anymore. If Japanese yields keep climbing, the rational move is to move capital back to Japan, where they can get a better real return than in the US or Europe. Don't forget, Japan is the largest foreign holder of US debt. If they start moving their money, it puts massive structural pressure on the US bond market. Since the US relies on foreign cash to pay its bills, a Japanese exit would trigger insane volatility. Simply put, if Japan stops buying, who will? If no one steps in, yields skyrocket, stocks tank, and the dollar weakens. This just speeds up the rush into gold. When the world's biggest creditors start running, would you want to be left holding the bag in the bond market? No, you'd buy the one asset that has survived for thousands of years, gold. To wrap up, I want to answer your questions about silver. Why did gold jump $100 while silver barely moved? This confirms our theory, the decoupling of gold and silver. In moments of pure, raw panic, the difference between the two is magnified. Gold is seen as pure money, the ultimate safety net. When people think the world is ending, they want gold. Silver, however, is 50% industrial. When the market trades on a sell America or trade war theme, it also fears a global recession. If a trade war kills economic growth, industrial demand for silver drops. That's a huge weight on silver's price. So, when panic hits, big money picks gold first. That's why gold hit 4,800 while silver stayed hesitant. But don't count silver out. Once the initial panic cools and people start worrying about inflation, silver's high-octane nature will return. For right now, though, gold is the undisputed king. We've covered a lot, so let's summarize. We are living through a once-in-a-century shift. Trump's pressure tactics and that map triggered a sell America fever, showing investors the risks of U.S. dominance. The U.S.-Europe capital war is making the dollar too hot to handle, and European pension funds dumping bonds is just the first sign of a long-term credit crisis. Global central banks are providing a massive buy wall for gold, with Poland's 150-ton order proving that gold is the ultimate survival tool in a conflict zone. The yen carry trade reversal is the sword of Damocles hanging over the dollar, ready to strike at any moment. All of this points to gold's rally accelerating. This storm might just be getting started. Right now, the U.S.-Europe capital war is mostly just talk, yet U.S. markets are already bleeding. Gold is already at $4,800. If these fears become reality and the capital war truly begins, if more pension funds start dumping treasuries, or if the Middle East worsens, gold could hit heights we can't even imagine. 5,000? 6,000? In a world where currency trust collapses, anything is possible. I want to leave you with this. The golden age of gold has only just begun. This isn't just a bull market. It's a massive redistribution of global wealth. It's a battle to protect yourself from currency debasement and geopolitical chaos. As always, a quick reminder, this analysis is based on my deep dive into current news and market logic. It's meant to help you cut through the fog and see the truth for yourself. It is not direct financial advice. Trading involves high risk. Everyone's situation is different, so please make your own informed decisions based on your own risk tolerance. That's it for today. If you found these insights helpful for navigating this complex market, please drop a comment and let me know what you think. Don't forget to like, subscribe to Gold Off Tehe Charts, and share this with your fellow traders. This is Gold Off the Charts. See you in the next one.